If you can write code at virtually zero cost using Claude, this has got to have an implication, a profound implication, for the economic foundation of the software industry.
$1 trillion has been wiped from software stocks in 2026.
I wouldn't want to step in the way of that tidal wave just yet. Google announced that their CapEx spend this year in 2026 would be somewhere around $180 billion. That's roughly about 5% of UK GDP. It's a game of poker where nobody can afford to fold. History tells you that your returns are broadly zero in real terms over the next 10 years.
Hello and welcome back to Noise Cancelling. I'm John and joined as always by Neil Woodford. Neil, we've got a really packed show today. 3 really big stories. First of all, the software sell-off. This matters even if you've never bought a tech stock in your life. Second, the Bank of England just announced on rates. We're going to see what it means for the rest of the year. And finally, Bitcoin, down 40%. Extreme fear, Michael Burry warning about the death spiral. Is this the buying opportunity of a decade or the end of the road? Let's get into it. Microsoft just had the second largest single-day value destruction event in stock market history, $357 billion wiped out. Only Nvidia's DeepSeek crash was worse. So, Neil, what actually happened?
There are a couple of things that the market decided were the reasons for that big fall on the day. I think there may have been a sort of subtext to the explanation, but the two reasons were that Microsoft numbers were a little bit disappointing in key areas. Essentially, I think the market wanted to see better growth from its cloud computing business, but what the market apparently took fright at was the increased CapEx number. But I think the subtext, which I mentioned a moment ago, the subtext is ultimately Microsoft. The business is the world's most successful software company ultimately, and I think there is a growing concern. I think, and it's a well-founded concern about what AI will do to the software industry.
Neil, I want to start by explaining why everyone listening needs to pay attention to this, even if they've never bought a tech stock in their lives. If you own a global tracker, say a Vanguard All World or an MSCI World ETF, wherever you hold your pension is probably 2/3 of it in US companies, and potentially even a quarter of it as technology. The top 10 holdings could mostly be tech giants, Apple, Microsoft, Nvidia, and they make up about 20% of the entire index. If you own the S&P 500, it's even more concentrated. So if you've got a pension or an ISA or a 401k, even a SIP, you're probably exposed to this story whether you chose to be or not.
As with all industrial revolutions, new technology comes along, and not only does it allow all sorts of new things to happen, but clearly the history of industrial revolutions, the history of new technology, is that it undermines the business models of established industries as well. And I'm pretty convinced that the industry fundamentals that have supported the software industry for a long period of time, and which have helped the software industry become a very important part of tech. Many software companies trade on extremely high ratings because they've been very successful, high growth companies. That is changing, and it will change, I believe, because of what a more sophisticated AI industrial revolution is going to do to the software industry.
And I think the second driver, or certainly one that's been cited, was Anthropic releasing a new feature for their Claude application, which is some helpers essentially, not a new tool, just a plugin for an existing piece of software to let it act more like your in-house lawyer or your project manager. And that seemed to be enough to combine with what you mentioned about their results to really smash the share prices of these software companies.
Yeah, in that particular example, some established software companies, particularly in the legal software industry, like Reed, for example, or RELX as it is now known, Thomson Reuters, these share prices came under a bit of pressure because they make a huge amount of money from legal software. So yeah, I think as a general theme, although I'm not suggesting for a moment that the large corporations everywhere are suddenly going to be ditching their software subscriptions and moving to sort of Claude generated bespoke software for their own organizations. That's not what I'm saying. The legacy users of established software packages are gonna carry on using them, but I think there's gonna be a major change in the growth dynamics of the industry as we go forward in AI industrial revolution.
The pattern we seem to be seeing so far is that hardware's up and software's down. But the companies that were supposed to benefit from AI, the Microsofts, the SaaS ecosystem, they're getting absolutely hammered. Why is AI good for chips but bad for software?
Well, I think it's a reasonably complex and layered argument, but remember, software came into this sort of period trading on very high valuations. I mean, I looked at a few this morning, and there was one company, Snowflake, I think, which was trading on 138 times earnings, despite its share price having cratered in the last 2 or 3 months. So these companies have traditionally been seen as very high growth companies. They have been high growth companies, and many of them trade on very high ratings as a result of that. And when you, as a general rule of thumb, when companies have very high ratings, there is very little margin for error. When things aren't quite as good as everybody hoped that they would be, there is the capacity for the market to really fall out of love with these companies, and not just software, but other company. Any company that's trading on a very high rating has little margin for error. And as a sector, I think software came into this period when people are asking, I think, very legitimate questions about what AI might do to software business models. A very legitimate question. They came into that period with very high ratings, lots of enthusiasm, a general view that software would carry on growing at historic growth rates. And I think that is now in question.
Yeah, because of course, if AI can write code, and increasingly we're seeing that it can, the argument, I guess, is why would anyone pay for software anymore? You could just have the AI build exactly what you need. Does that mean that software as a business model is dying?
I think that's a bit extreme. I don't think it's dying, but I think its terms of trade are taking a turn for the worse. Clearly, the premium that you can charge for a particular package may erode if suddenly all sorts of new competitors can deliver at very low cost competitive software applications. So I think it's not that the business. It's not as if the internal combustion engine brought an end to the horse sort of economy. That's not what I'm saying. I'm not saying that this industry is going to end tomorrow at all, but it's very advantageous sort of terms of trade, the economics, the profit margins, the revenue growth that software has enjoyed traditionally. I think is going to come under pressure because AI changes a lot of things for the software industry. And as you just demonstrated with that one example, if you can write code at virtually zero cost using Claude, this has got to have got to have a profound implication for the economic foundation of the software industry for me. You asked also about chips. What's the difference between hardware and software? Apart from the fact that the valuations were, diametrically different, the fact is that it's very, very clear that the chip industry is benefiting massively from the huge CapEx budgets that are going in everywhere into AI infrastructure. So the chip industry is out up there as one of the major beneficiaries, if not the greatest beneficiary of this massive capital investment program. I mean, I saw today there was an announcement from Google. I don't know what's going to happen to Google's share price, but when the market opens in the US, but Google announced that their CapEx spend this year in 2026 would be somewhere around $180 billion. That's roughly about 5% of UK GDP, by the way, 4.5%, 5% of UK GDP. And the market had been expecting a number about 120 billion. So, these are huge numbers. they're clearly going to be bigger than the market was anticipating. And so, I think the momentum around, for example, why hardware and chip industry in particular is going to carry on benefiting from this is very, very clear. But by implication as well, you know, not everybody gains from the Industrial Revolution, and the history shows us that when new technology is deployed, there are going to be winners and losers, and I'm pretty confident that the business model of the software industry is going to be challenged by this.
The counter argument, of course, that is slightly more bullish for software is that most companies just don't want to become software companies. It's not their core business. Writing an app, writing some software is just the beginning. You've got maintenance, you've got security patches, you've got ongoing compliance. You're not just buying the code, you're buying a product with support and integrations. And that is really, I think, where software companies are going to have to lean on and rely on to to have a future.
The software is embedded in every business, so it would be ridiculous to assume that suddenly companies are going to sweep away all of their established software infrastructure and start, deploying lots of bright young people with Claude subscriptions and rewriting everything. That's not what I'm saying. But bit by bit, the industry its growth dynamic is going to change. Its terms of trade are going to change. What it can charge for its software, what the software industry has traditionally been able to charge for software, for upgrades, for new packages. I think that's where the pressure is going to come to bear.
I guess as well, software companies arguably should be best positioned for writing more and better software now. Effectively, if software companies can now write infinite code, that should mean that the neat siloed SaaS ecosystem that we have at the moment should expand, and everybody will be expanding into everybody else's territory.
Yeah.
I guess the next decade could be about not just growing their audience, it's about fighting to keep it.
Yeah, it's about fighting and competition within the industry as business models evolve. I mean, it's absolutely clear to me that the software industry is one which will benefit massively from the deployment of AI. I mean, there are thousands of well-paid coders, employed within software businesses. They are going to, I think a lot of those people are going to lose their jobs. So, software will become more productive. Software businesses will become more productive, but equally they will also be enabled to compete with each other. And typically, when you get more market entrants, price suffers, margins suffer, and that's what I see. That's how I see the future evolving for this industry.
We've seen quite a big slip in valuations. Sometimes that comes with a buying opportunity. Are there any buying opportunities that you've spotted over the last few weeks or months?
Nothing's leaping off the page yet. Not least because remember the position from whence these companies have come. These were highly rated, some of the highest rated companies in the US market on very astronomical ratings, a widespread belief in their ability to sort of compound very high growth rates on very high margins. That assumption has to be called into question. And so the ratings are coming down, the enthusiasm is coming down, and I think there is more disappointment coming. There's more nervousness coming, frankly. So I wouldn't want to step in the way of that sort of tidal wave just yet. No.
Jensen Huang, NVIDIA's CEO, was talking about a future workforce of humans and digital humans all working together. Every designer gets a team of AI companions, for example. He says the market for agentic AI labor could be trillions of dollars. Digital nurses, lawyers, accountants. Is this the vision, do you think, that justifies the spending?
Yes, I think it is. I can see why his vision is something that is clearly driving Google's decision to say, right, we are all in on this. We're going to spend $180 billion in 2026 or more to ensure that we are going to lead. We are going to be at the cutting edge of this industrial revolution. We can't afford to come second or third or fourth. We have to be at the cutting edge. We have to be really, really good at this. Recognizing that they need to massively increase their capital spending. They need to be at the cutting edge. It's not just that they can't afford to come second, but they can see the payoff. What coming first means, or what dominating a particular segment of the market means in terms of economic return. I'm absolutely convinced there will be winners and losers in this race. Not everybody who's spending huge amounts of money right now is going to get an adequate return on that investment. It's absolutely clear. But what do the companies do? They really don't have an alternative. They can't just say, I'm out of this. It's a bit like it's a game of poker that where nobody can afford to fold.
Neil, let's now take a look at the bear case, and it's potentially quite scary. Julian Garon has argued that this is the biggest capital misallocation in history. He says it's 17 times worse than the dot-com bubble. He's argued that generative AI has fundamental technical limitations, and we might agree or disagree on that. But the real-world commercial applications are failing at rates between 65 and 99%. How do you read that?
Well, I know Julian very well. He's a very smart guy. But I do worry about his. I mean, he makes some very cogent arguments, and they make me stop and think. But I'm not as bearish as he is about this industrial revolution and this CapEx. And I suppose it's a product in part of know your limitations. I mean, I don't pretend to understand this technology as well as people like Jensen, Huang, and all of the people who are building these incredible new AI companies like Anthropic or OpenAI. I don't pretend to know as much as these guys. It would be a remarkably stupid example of mass hysteria if Julian's argument was correct. I just don't think it is. Now, where I think we would agree is that there is bound to be, within this sort of headlong race to deploy huge amounts of capital in order to ensure that you are at the end of this process, whenever that is, and I'm not sure there will be an end. It'll just be a series of sort of races that stop and start again. But the companies like Google and Meta and Microsoft, they just know that they can't afford to come second or third in this race. They have to participate. They have to invest. Not all of that investment is going to deliver a great return, but I still think that we have yet to really understand how these models can transform productivity in across different businesses, across different industries, and in so doing, deliver the sort of economic return that we all hope some of this investment will deliver. To some extent, and I know this will make people very nervous, but to some extent, you have to have some faith in the judgment of the people who are leading the decision making in this industrial revolution. They're very, very smart people. They're not stupid. They do understand the risks they're taking. They do understand the need to deliver a return. Then this is not some drunken fool just sort of spraying money around like a lunatic. This is very, very considered, in my opinion, and it's very considered. It is the considered judgments of some of the smartest, most entrepreneurial, most smartest people that we have in the Western world, and indeed in China. I mean, let's not forget, there's a huge amount of investment going into this revolution in China too. So I'm not as cynical, and I'm not as suspicious about what's going on as Julian is.
I wanted to ask you, Neil, about the circular vendor financing, this idea that the whole AI infrastructure is being funded by money that ultimately traces back to the same small group of companies, all lending to each other. Is that something we need to worry about?
Look, I think it's wrong to characterize everything as, vendor financing. Clearly, there are people are placing bets across the industry. Nvidia is placing bets across the industry. I mean, it's talked about $100 billion investment in OpenAI. Whether that actually happens or not, I don't know. But all these companies have, well, Nvidia in particular has a vested interest in nurturing this industrial revolution, and clearly it's generating way more cash than it knows what to do within its business. And rather than buy back shares, I think it's sort of hedging its bets by placing very big, tens of billions of dollar bets in the companies that are using its technology. And that to me is that's a rational process. But once again, we come back to the sort of, the notion of extremes. I just don't believe I just don't believe that this is all a sort of house of cards. These companies are generating vast amounts of cash flow from their embedded businesses, and they're employing that cash flow along with some debt to finance these huge CapEx budgets. Um, the numbers are very big. They're very frightening. They are hard to
Well,
get your head around. But I think it's a false narrative to say it's all some sort of mountain of bullshit, and it's all sort of the equivalent of vendor financing, but essentially giving money or lending money to your customers so that they can buy your product. That I think is a too extreme view of an excessively extreme view of the characteristics of this industrial revolution.
well, let's just look at the punchline of Garen's article, which was, if this does reverse, he calculated it could knock between 3 and 6% off of GDP, which is more like a recession than a correction. What sort of probability would you put on that scenario coming to pass?
I agree that if there was a shock in the system that dramatically undermined this industrial revolution and all of the capital expending that's going on, that is a characteristic, that is the lead characteristic of this industrial revolution in some respects, then I agree that would be a very big shock to the US economy in particular. It wouldn't just affect the US economy, it would affect many other economies. But I mean, I've seen some reasonably well-informed data that suggests that 60% of US GDP growth is linked in some way, shape, or form to AI infrastructure investment. So it's logical to think, well, if that came to a shuddering end, clearly there will be a big impact on the US growth, on US growth rate, and it arguably might lead to a recession. Um, you've got to ask yourself, what is the thing that would lead to this industrial revolution suddenly coming to a halt? And I'm not sure I see anything on the horizon right now that brings that about at all.
So we've got three views here. Software survives, but the landscape reshapes violently. Jensen Huang saying this is the beginning of something transformational, and Julian Garen saying the whole thing is a bubble that's about to pop. Between those three arguments, where do you land, Neil?
I'm more with I certainly am on board with the winners and losers argument that effectively points at the software industry as a relative loser. I'm pretty convinced that what's happening in financial markets right now with the software sector, as you said right at the start, having lost, I think, something like $1 trillion in market cap in the space of a few weeks, I think there's a very clear rational argument behind what's happening there. Agree with that. Jensen Huang's sort of his narrative, I'm tend to be sort of more aligned with that vision. I'm not sure I always understand what he's talking about, but I think he's not alone. I mean, you listen to Elon Musk and listen to what he says about how robotic humanoid robots will become so dominant across industry, and will transform industrial productivity across all economies. it's a very exciting vision of the future in some respects. It's also equally frightening in some respects as well. But nevertheless, the massive productivity miracle that will come if these people are right is something that will transform living standards, transform economies, and enable us to do things that we can barely imagine right now. I'm more in that camp than I am in the Julian Garing camp, which is it's all a house of cards and it's about to come tumbling down. I'm not in that camp. Equally, I'm not a sort of, I'm not blind to the risks. I am very conscious of the risks associated with the characteristics of this industrial revolution. But equally, I understand that none of the leading companies, and indeed none of the leading economies in the world, can voluntarily just say, oh, it's all just a bit too difficult. It's all a bit sort of unclear. We don't have absolute clarity on what the ROI will be on that particular lump of CapEx. Therefore, we're just going to jump off and sit here on our hands and wait. That is not a viable strategy for any of these businesses, or any of these economies either.
Well, let's try and make this practical for people. Someone who's listening to this may just have realized their pension is in a global tracker fund and therefore about 35% of it is exposed to tech that they may not have chosen. What can they actually do about it? Are they stuck just riding this out, or have they got any options here?
Well, look, this is a characteristic of what I've been saying since we started these podcasts and what I've been writing about, which is that investors should not expect the incredible journey that many of them have enjoyed in the S&P 500 to continue. When valuations get to extreme levels, which they have done in the US, you should expect that returns over the next 10 years broadly. Let's take 10 years. It's a sort of convenient and symmetrical number. But anyway, the real returns over the 10 years, the future 10 years from today, when you start in a market that's on about 22, 23 times earnings, which is broadly where the S&P 500 is, your history tells you that your returns are broadly zero in real terms over the next 10 years. Ray Dalio has been talking about this in the last week in an interview that I saw. It's what I've been saying for a long time. And it's foundationally important for investors. So I think they really do need to think very carefully about perhaps the default sort of decision, which was, well, of course I buy the S&P 500 because it's done so well. It's outperformed everything for so long. I just keep buying that thing. I think investors need to understand that the performance of the S&P 500 has taken valuations to a level which I believe means that anybody who is just buying that index now I believe they should expect that the next 10 years returns from that index will likely be very disappointing. And so the excitement and the interest that I have is away from that valuation extreme. Have always been a valuation driven investor. What I'm looking at is, where are the valuation anomalies to the downside? Where are valuations too low? And where does that lesson of history work in your favor? And I've said that the UK equity market is what I would highlight as still a very attractive opportunity.
Neil, you've been bullish on the UK economy for months when everyone else has been doom and gloom. You said inflation would fall faster than expected. How is that call looking?
I think broadly right. In fact, the Bank of England today has surprised me. I did think that they would reduce their inflation forecast, and they have, but they're actually more bearish on inflation than bearish. I mean, inflation goes down than I had expected. So they agree with me, or maybe I agree with them. But anyway, they agree that the CPI will be down at 2% in April this year, which is something I've been saying for a while. But they go beyond that and have given a sort of slightly longer term updated inflation forecast, which was the bit that surprised me. And in that, they've said that inflation, for example, next year in 2027 will average 1.8%, i.e. below the Bank of England's 2% target. And inflation further out seems to be further well behaved. So in some respects, not only do I think I was right, but actually the Bank of England has gone beyond what I thought it would do and has now forecast an inflation rate that is broadly below target for most of the next year and a half, at least.
Well, the bank held rates at 3.75% after a surprisingly close vote. It was markets had about 96% probability baked in, so there aren't any big surprises. But given everything you've said, do you think they're being too cautious?
Yes, I do. I find today's decision really hard to rationalize. So the summary view here is that not only did the Bank of England reduce its inflation forecast for this year and for next year, but it also reduced its growth forecast, which I have been saying already looked way too bearish. But they reduced their growth forecast for the UK economy for this year from 1.2 to 0.9% growth. I just don't know how they've got to that figure, but nevertheless, that is what they're forecasting. I think they'll be wrong, by the way, profoundly wrong, but let's go with the situation as it currently is. So, in summary, today, the Bank of England has reduced its inflation forecast and reduced its growth forecast for the UK economy, and yet has kept rates on hold. Now, that just does not make any sense to me at all. There are all sorts of warm words around the decision. The vote was 5-4, so it was a close vote, closer than the market had expected. But in the context of a lower inflation and a lower growth forecast, I'm really struggling to understand why interest rates weren't cut today. Let's not forget that 0.9% is some way below the OBR's rather sort of gloomy potential growth rate for the UK economy, which is 1.4%. So it just doesn't stack up. This is more central banking mumbo jumbo, and it's deeply frustrating. I don't understand the caution. The swing vote, by the way, was Bailey's vote. So the essentially the committee was split 4-4, and Bailey came down on no change, which again I just think is mad. I just don't think it really. Not only is it hard to rationalise, it just further undermines the Bank of England's credibility. It seems to me, it just seems a totally irrational decision, and one laden with academic nonsense and absolutely no pragmatism, no judgment, no common sense, really.
But the thing that's so frustrating is if the trend is so clear, why wouldn't you want to get ahead of it?
Exactly. I think that the objective of central banks is not to be reactive necessarily, but to anticipate trends in the economy. I mean, this is what you hear from the Fed all the time. You ask a very good question. Why wouldn't they get ahead of that trend? If growth in the UK is now going to be even weaker than they expected before, and inflation is lower, there is no justification for not cutting rates. Anyway, the general view is that they'll cut in March by a quarter point. They'll probably cut again in May, and that will bring us to 3.25%. I think they'll cut again in August, maybe to 3%. So rates are undoubtedly coming down, and they are broadly coming down to the level that I've been talking about for months now. But frankly, we need lower rates now. We needed them at the end of last year. We needed that cut today. We haven't got it. It's really frustrating. It just further undermines, in my view, the already wafer-thin credibility of the Bank of England.
And of course, every month that they delay, that's another month of higher mortgage rates, tighter business lending, weaker consumer confidence.
Indeed. In not moving rates, in being too cautious, is just costing the economy in terms of growth and output and employment and lower interest rates and better consumer confidence. All these things are naturally going to improve when the Bank of England gets off its sort of pedestal and starts cutting rates again.
Okay, well, let's talk about the final story of this week. That is Bitcoin, because if you thought software was having a rough time, crypto has been absolutely brutal. Bitcoin is now down about 40% from the highs. The fear and greed index is at 15, extreme fear, $2 billion in liquidations. And Michael Burry, the guy from The Big Short, is warning about a death spiral. Neil, can you try and explain what's actually happening here?
Anybody who's listened to what I've said before knows that I've never really understood what has driven Bitcoin in the first instance. I very much subscribe to the Warren Buffett view of Bitcoin, which is, what do you do with it? I mean, once you've bought it and own it, really the only thing that you can do with it is hope that you can sell it on to somebody else at a higher price than you paid for it. It has no real utility in my view. So I've never really understood why Bitcoin, became the thing that it became. It's had pretty violent setbacks in the past. So this is not the only violent setback Bitcoin has endured. I mean, I think back in 2022, I think it fell by something like 60 or 70%. So, although the absolute fall is the biggest one we've seen in Bitcoin, the percentage fall doesn't really rival what we've seen in the past. But having said all that, I don't think it has utility. I would never invest it myself. I would never own it, and I don't really know why people do. Um, I've never heard a rational explanation to that fundamental question. So, I'm a sort of an interested observer of this sort of this bear market in Bitcoin. As I've said in the past, I wouldn't be surprised if it falls to a much, much lower level, and I've said in the past to zero. I wouldn't be surprised by that. It could be $50,000 tomorrow. It could equally rally. I mean, it is a very strange thing that I think plays on human emotion that has driven excesses in financial markets for as long as they've existed. I mean, just look at what's happened to the silver price or the gold price in recent weeks too. These are all manifestations of the sort of fear and greed thing that and the fear of missing out, of course, that have gripped financial markets for hundreds of years.
There's two ways to read moments like this. One is the classic Buffett interpretation, which is be greedy when others are fearful. When there's blood in the streets, it's potentially a generational buying opportunity. And the second is that this could just be the true value of Bitcoin being realized, which, is to say zero. Where do you stand on these two arguments?
I fully signed up member of the be fearful when others are greedy, be greedy when others are fearful. That contrarian summary is really essentially one that has described how I've looked at investment over many, many, many years. So I agree with that, but I think it applies to real assets, to financial and real assets, not to something like Bitcoin. I wouldn't agree that sort of rationale applies to something which I do not understand the sort of fundamental sort of value of. What they hope ultimately the owners of Bitcoin is that they can sell it tomorrow or next week or the week after to somebody else for a higher price than they paid. That's the only rationale really that I can see for owning Bitcoin.
Have you seen other death spirals like this in other assets?
There have been death spirals in individual companies' valuations, in markets from time to time. I mean, in the last 100 or so years, the in the middle of the Wall Street crash was a devastating event in 1929. The Nasdaq melted down in 2000. I can't remember how much it fell, but I think it was between 60 and 80%. There have been plenty of examples in more conventional financial markets of death spiral. Sounds a bit sort of emotional, but of major bear markets which have completely rebased valuation. But it is, for me, always it is valuation that is it's like the force of gravity that ultimately exerts its influence over everything, every financial asset. It's indisputable.
What would need to happen, do you think, for sentiment to shift?
It's very simple. The market to recover needs more buyers and sellers.
Okay, Neil, well, let's wrap this up. We've had 3 big stories this week. UK rates on hold, software in crisis, and Bitcoin in a free fall. If you had to pick one thing for listeners to remember from this episode, one takeaway that they should consider acting on, what would it be?
God, I probably will end up sounding very, very boring, but I think it is valuation. I keep coming back to that. It is valuation, really, that ultimately exerts that sort of undeniable force eventually on all financial assets.
Neil, I think that's a great place to leave it. If you found this episode useful, and I really hope that you did, please do hit that subscribe button, whether you're on YouTube, Spotify, or Apple Podcasts, wherever you're listening. Subscribing really helps us to reach more people who are trying to make sense of all of this noise. And if perhaps you know someone who needs to hear this, maybe they've got their pension in a global tracker, they don't realize how much tech exposure they really have, or maybe they own Bitcoin and they're watching the price drop day after day, please do send them this episode. And if you enjoyed Neil's take on the UK economy, go back and watch our 2026 outlook. I'll leave the link in the description, or you can find it on our YouTube channel. That's it for now. Neil and I will, of course, see you next week. Until then, take care.